Hola, hola chicos, ¿qué tal? ¿Qué tal? ¿Cómo están? Quiero saludarlos. Bueno, algunas personas que están acá son del equipo, algunas personas no. Bueno, voy a dejar esta grabación para darle los pasos iniciales que deben hacer cuando van a iniciar dentro del proyecto de By Design. Cuando la persona comienza, va a tener que realizar una serie de cursos, que esos cursos son los que te van a dar todo el paso a paso de cómo debes iniciarte dentro de este tipo de proyectos. ¿Cómo puedes tú iniciarte? ¿Qué es el Forex? ¿Cómo puedes tú iniciarte dentro de esta plataforma? O sea, es algo muy importante a día de hoy para las personas que quieran desarrollar negocios digitales, el tener un mentor, tener un sistema que te dé el paso a paso, porque si no tienes un sistema que te pueda decir qué es lo que debes hacer, va a ser muy complicado para que puedas ir desarrollando el negocio. Así que, bueno, le voy a mostrar en sí lo que es nuestra plataforma y qué es lo que nosotros hacemos, cómo lo hacemos y cómo podemos lograr también tener resultados, ¿no? Voy a silenciar. Vale, primeramente, para las personas que no conocen, estamos en un negocio que se llama By Design. Cuando ustedes colocan bydesign.com, te va a aparecer, se te va a abrir esta página, ¿vale? Esta página principal, luego te vas a ir acá donde dice Account, vas a darle donde dice Lockout. Bueno, yo estoy ahorita ya suscrito, voy a colocar Sign In para entrar. Vas a colocar tu nombre de usuario, que lo debes tener, tu nombre de usuario. Yo voy a colocar este que es el de mi chica, que es la que está haciendo la academia. Vas a entrar a la plataforma y te vas a encontrar con esto. Ya cuando tú estás dentro de la plataforma, te vas a ir a donde dice My Products, mis productos, ¿vale? Y vas a entrar a donde dice Smart Market Academy. Hoy vamos a hablar sobre lo que son los aspectos fundamentales de lo que es el Forex, ¿vale? Vas a colocar acceso a la academia, lo pueden colocar en español también, yo lo tengo en inglés, pero lo pueden colocar en español, en japonés. Aquí vamos a colocar en español para que puedan entender un poco las personas que no lo entienden. Vamos a colocar acá ingresar ya, ¿vale? Ingresar ya. Ahora que están, se le va a abrir a usted este tipo de, esta página. Las personas cuando se suscriben por primera vez, te va a pedir una serie de requisitos, tú los llenas y luego te vas a abrir esta página. Vale, cuando abres esta página, te va a aparecer las siguientes opciones. Te va a aparecer que tienes el SMAFX Fundaciones y le vas a dar continuar. Ya cuando estás dentro de esto, te va a aparecer que tienes que terminar cierta cantidad de cursos, ¿vale? Este es el curso, son 101 cursos, imagínate. O sea, tenemos que hacer todos estos cursos que se encuentran al lado izquierdo para poder saber cómo desarrollar el negocio, ¿vale, chicos? El Forex no es un juego, de verdad que el Forex tiene muchísimas cosas que deben saber. Así que espero que tengan lápiz y papel, va a comenzar el curso. Así que bueno, tomen nota, ya les enseñé cómo se entra y comenzamos viendo esta clase. Vamos a ver para repetirla, estas clases las vamos a seguir repitiendo. Así que nada, vamos a comenzar, voy a colocar el audio.
Now let's educate ourselves on what is the Forex. The name Forex is an acronym for foreign exchange. It is comprised of 4,500 world banks. And although we trade the most popular currencies around the world, there are 7 major world currencies that we focus in on. The foreign exchange still is comprised of all the world currencies, and it is an international market. Now, the Forex literally goes 24 hours a day, 5.5 days a week. Actually, the actual foreign exchange goes 7 days a week, 365 days a year. But for retail traders, it literally goes 5.5 days. It starts literally at 7 p.m. Eastern Standard Time. But that is when Asia opens up. Now, when we talk about Asia, we're talking about China, we're talking about Japan, we're talking about New Zealand, we're talking about Australia. That is the Asian market. Then, as it opens up at 8 o'clock their time, which is 7 p.m. Eastern Standard Time, it literally starts up, and then at 8 o'clock in the morning, Greenwich Mean Time or London time, what ends up happening is the London market opens up, which is 3 o'clock in the morning Eastern Standard Time. And so it really depends on where you live. You'll have to check your time frames to see when the markets open up, depending on where you live. But we are here in Florida. We're on Eastern time zone, so it starts off with Asia. You can see Asia goes for about 4 or 5 hours, and then it overlaps London. Now London opens up. London is the most popular market in the world. What I mean by popular, 75% of all currency transactions take place in the London market, which is called the active zone. It's called an active zone. But London goes from 3 a.m. to roughly 12 noon Eastern Standard Time, which is 8 a.m. Greenwich Mean Time or London time, all the way till 5 p.m. London time. And then Asia shuts down, and about a half hour later, the U.S. markets open up. And so you can see that London and Asia overlap each other for a little while, and then London and U.S. overlap each other. London closes down around 12 o'clock Eastern Standard Time, and then the U.S. market stays open till about 5 p.m. Eastern Standard Time. And so there is no one physical location. We're talking about locations all over the world. It's not like trading like in a pit or like at the New York Stock Exchange or the Chicago Mercantile Exchange. We're not talking about pits anywhere. We're talking about 4,500 world banks stationed all over the world that comprise of the Forex. Now let's talk a little bit about what we're doing when we trade the Forex. The first thing you need to understand is that trading on the foreign exchange, where we trade one country's currency against another currency, is that currencies are a commodity, and they go up and down in value depending on supply and demand. When there's an abundance of supply, prices go down. When there's a short supply and a huge demand, prices go up. So it's all about supply and demand. And what we're doing is we're trying to make money on that supply and demand and the fluctuations. So we're going to talk about the value of one country's currency against another country's currency, because what we're talking about is exchanging one country's currency with another country's currency, and we're going to try to make money on what's called the fluctuation of those two currencies. Now, pretend you are in America and that you are going on vacation somewhere. And what I've picked out is I've picked out Canada. Let's just say I'm an American and I want to go to Canada for 2 or 3 weeks on vacation. And let's talk about that if I went from here to Canada, let's just say the two currencies are of equal value, okay? To where $100 in America would equal $100 in Canadian dollars. Now, currently, as we speak, the Canadian dollar is weaker than the US dollar, which means that the exchange rate right now is sitting at about $1 US for about $130 Canadian. So let's just say we went to Canada from the US and they were of equal value. When two currencies are of equal value, it is called a par value. They're of equal value. So let's just say we go to Canada, and while we're in Canada, we had a nice time, but now it's time to return home, and we didn't spend all our cash in Canada. So what we want to do is we now want to exchange our money back into America. Well, naturally, because the average person doesn't keep up with the currency rates as they're on vacation, but when it's time for us to convert the money back from Canadian to the US. We go to that little exchange booth and we give them our $100 of Canadian, and they turn around and they only give us $80 back. And we say, well, wait a second. When I came here, I got dollar for dollar. I gave you $100, you gave me 100 Canadian. And then the person says, yes, but while you're on vacation, the currency weakened. And since it weakened, that means your $100 is only worth $80. See, that's what's called fluctuation. It's also called supply and demand, and that's why it's called a commodity. Now, when it's time to trade, traders trade in what's called pips. If we were trading in the stock market, we would trade for points, okay? And each dollar is a point. Let's just say Microsoft. It went up $1. It went up 1 point, okay? In the foreign exchange market, we are trading for what is called pips. And pips is an acronym for price interest point. That's what it means. It's a price interest point. And so if we were in the stock market, we'd be literally trading $1, which is a point, and in that $1 is 100 pennies. Now, I want you to think about that, 100 pennies, because we're going to take those pennies and we're going to equate them to a pip in the currency market, which means if, let's just say any stock was valued at $60, and then it goes to $60.01. See, in the foreign exchange market, that would be a 1 pip move up. And so what we're doing is when we trade, we are trading at 1/100th of a dollar, or even 1/1000th of a penny. And I'm gonna show you this, exactly what I'm talking about. But we trade in what's called pips, okay? And that's what we're trying to do. We're trying to capture pips. That's what trading's all about. Just like in the stock market, you're trying to capture points. We're trying to capture pips. So look at this chart. This is the Euro GBP, and it has been rallying. It has been going up, making higher highs and higher lows. This is called an uptrend. And so if you look over here, this is price, and down here is time. So we've got the market moving from May 14th till June 28th of 2019, and you can see how the currency has increased in value. Now what I'm going to do is I'm going to enlarge this section right here, because this is how you read your pips. Because they're traded in 1/1000ths right here, this literally is trading at 0.89680, okay? Now, the 68 are the pips. So it would be literally 68.0, okay? This could say 68.5, which would mean 68.5 pips. It could say 68.3, which would be like 68.25 pips, because they're literally traded in 1/1000th of a pip. And so the majority of currencies are literally a 1 point and then whatever it is, which is the first 1, 2, 3, 4 numbers, and the last 2 numbers of that are your pips. Now, so let's look at a Japanese yen chart. Now here's a Japanese yen chart, and in this Japanese yen chart, look at the prices over here, okay? Here's the prices. You can see they go 120, 140, 120, 160, 120, 180, and now I'm going to blow these numbers up. And so when you look at this, this is traded at 121.916, okay? So this is a 1/6 of a pip. These are your 91 are your pips. So you can see we go from 60 to 80, which is 20 pips, 80 to 91, which is 11 pips, 80 to 2,000, which is 20 pips. So that's how you read your pips. And what a trader's trying to do is they're trying to capture pips. Now let's talk about what we're trading when it's time to trade. As a trader, you have three options. You can trade what's called a micro lot, and because we're trading on margin and we're trading at 100 to 1 margin, I want you to think about that. You're literally trading $1,000 worth of currency. You're exchanging $1,000. I'm going to take $1,000 of US dollars and I'm going to exchange it for Canadian dollars, okay? So if I take $1,000, because we're trading on margin, you do not have to ante up the $1,000, depending on the brokerage firm where you trade at. If you are in a brokerage firm that offers 100 to 1, then you literally are only going to ante up $10 to be able to trade to make 10 cents a pip. Now, if you're trading at 50 to 1, you're going to have to ante up like $20 to trade this, depending on your brokerage firm around the world. Certain countries have regulations about how much you have to ante up in margin. So we have micro lots. Our next one is called a mini lot. Now, when you trade a mini lot, you are literally trading or exchanging 10,000 US dollars for another country's currency. I talked about Canada, so we'd take 10,000 US dollars, we'd exchange it for 10,000 Canadian, all done on computer. But as the market moves and fluctuates, you will be making and or losing $1 a pip. Now, because margin requirements are 100 to 1 in certain countries, then what we're talking about is you would ante up roughly $1,000 to be able to make $1 per pip. Now, the third lot we can trade is called a standard lot. And in a standard lot, we are literally trading $100,000 worth of currency, and we get paid or we lose $10 a pip. So now I want you to think about this, okay? If I trade 2 micro lots, I'm making 20 cents a pip. If I trade 5 micro lots, I'm making 50 cents a pip. If I trade 10 micro lots, that's the same as 1 mini lot. Do you understand that? If I trade 10 micro lots, it's the same as trading 1 mini lot. Now I can trade 1 mini lot all by itself, or I can trade 12 micro lots, which would be 1 mini lot and 2 micro lots, or a total of 12 micro lots, or a total of $1.20 per pip. Now, if I wanted to trade 2 mini lots, I would get paid $2 or lose $2 every time the market fluctuated. So if I traded 10 mini lots, I would be trading 1 standard lot. And so we're going to get into details about how all this works when it comes time for us to talk about margin, but this is how currencies are traded. Now we're going to talk about the trading process, and we're really going to go into detail a little further into this lesson about the trading process. But I want to give you a quick overview of exactly how this works. If you're a trader and you're sitting down and you're looking at the market and you're thinking about buying the market, and here's where the current market is, then you're going to want to enter the market, buying the market, just like it says right here. There would be your entry to buy. Now, if you buy, you are a bull. Your position is called a long position, and you're wanting the market to go up. Now, one of the things you need to realize is that when the market moves, it waves. And so if the market is going to start to go up, it's more than likely going to go up, making higher highs and higher lows. Now, it'd be great if traders around the world were right 100% of the time. But there is no way in the world you can be right 100% of the time. Some of your very, very best traders around the world are right probably 50, 60, even 70% of the time. And so this is all about equity management, which we're going to go into detail further on in these lessons. But we're trying to pick direction, and we're going to be teaching you how to find direction. That's very important. But let's just talk about we want to buy right now. Now, with every single buy that exists in the market, you need to have 2 exit orders. The first exit order is what's called a stop loss order. What we're going to do is we're going to try to quantify the potential loss that we could incur. And then we're going to have what's called a limit order for profit. So here's the market. We want it to go up. So we are going to quantify a stop. How much money am I willing to lose? And then we're going to focus in on how much money we can make. And we are going to focus in on 1 to 3 ratios, which means for every dollar I risk, I want to try to capture $3 in profit. So let's take a look at this. We've made a decision to enter the market. We now need to place what's called a stop order for potential loss, just in case we're wrong, and a limit order for profit. Now, take a good look here. Look at the distance between our potential loss that we get to quantify before we enter the market, and let's look at its ratio compared to the ratio of profit. We've got about a 3-to-1 risk-reward ratio, okay? So after we enter, we literally have quantified a loss. We've quantified a potential profit. There is nothing you can do from here on out. And this is called an OCO. We're going to talk about this in the future. One cancels the other. But now that you have found an entry, found a stop, found a limit to get out, you can set it and forget it. There is no need for you to stare at these charts. There's no need for you to pray and hope the market goes your way. Listen, you have no control over this market. The only thing you have control over is yourself, what you do. And one of the greatest tragedies of all beginner traders is they love to fiddle with their trades. And we're going to talk about that down the road. But listen, the best thing you could do is learn where to find an entry, learn how to quantify a stop, make sure that your risk reward is in proportion, and that you're going for 3-to-1 on risk reward. Now, I love the saying. It goes like this: champion traders learn how to win their trades before they ever execute a trade. They plan a trade before they enter, and then they trade their plan. Well, beginner traders or novice traders, they will jump into the market without a plan. And then after they jump in the market, they're like, oh man, I didn't even analyze my charts. What am I supposed to do? See, and then they fight to win. You're not here to fight to win. You're here to learn how to properly plan a trade and then trade your plan. See, what we have here is we have a planned out trade. Here's my entry. Here's my loss. Here's my limit for profit. There's nothing I can do about it. I just need to let it run, and whatever happens, happens, okay? See how the market starts to rally up and come back down and rally up and come back down, it making higher highs and higher lows, and then it hits our target for profit. See, look at our risk-reward ratios. Risk versus reward. Now let's talk about how this takes place in a, if the market ends up stopping us out, okay? So let's take a look here. We found a trade. We put in our stop loss order. We put in our limit order. And like I said, you cannot win 100% of the time. There is no such thing as an undefeated season. Like in basketball or football or any sports, you can have an undefeated season. When it comes time to trading, you cannot have an undefeated season. Best you can do is learn how to find trend direction, enter the market, set it, and forget it, okay? Now here the market starts to go up, and what does it do? it comes down and stops us out. But I want you to think about this. No sense in getting upset that we got stopped out. I mean, after all, we quantified how much we were willing to lose. And if you cannot be okay with that quantified loss, you should not be trading, okay? And if you are trying to have an undefeated season, you cannot and should not be trading, because you cannot have that undefeated season. So what you need to learn, and what you will learn in the lesson on equity management, is, do you realize if you have the proper equity management of 3-to-1 risk-reward ratios, do you realize you can be wrong 70% of the time and still deposit money in the bank? And that's what you're going to learn in the lesson on equity management. So now let's look at it in a downtrend where we're going to short the market. So here the market has come down and then it's rallied back up. It's near resistance. And so we're thinking to ourselves, you know, because that's what you're going to learn. You're going to learn to sell resistance, buy support. We're near resistance. And so we decide to enter the current market. Now, when we enter the current market, we once again have to quantify a potential loss. If we enter the market right here selling, we are bears. Our position is a short position, and we want the market to fall or go down. And so when we enter our position, we have to place a protective stop loss order, and we want to place a limit order where the risk reward ratios are in place. Now the market starts to move, and as it starts to move, it comes down and it fills our limit order. Okay, so you can see there we're in the money, 3-to-1 risk reward ratio. Now let's take a look at it where we enter the market, we place our stop order, we place our limit order, and after we have set it, all we can do is forget it, because getting your heart rate up, hoping and praying that the market goes your direction. And I'm going to tell you something. I've been all over the world and worked with all kinds of traders. And traders, especially novice, new traders, guess what they do when they get in the market? The first thing they do is start praying. Oh, please, God, let this market go my way. Well, let me tell you my experience about praying, especially when it comes time to the market. Sometimes God will say yes. Sometimes he'll say no. Sometimes he'll say maybe, but the majority of the time he says, you got to be kidding me, okay? Literally, praying's not going to help move this market in your direction. We're talking about a $5 trillion a day market. They're not going to move the market because Bill in Ohio or Roger in Australia is having almost a heart attack. His heart rate's up. No, listen, you have no control over this market. As I've said before, all you can do is learn how to find trend direction and let it go. So here you can see the market starts to go down, doesn't go to our limit, and rallies back up and stops us out. But that's okay. And one of the hardest things novice traders have to overcome is learning how to take a loss. And that it's okay as a trader to take a loss. You know, the older we get, we have a tendency to pride ourselves on making good decisions. But the truth of the matter is, you can't make 100% right decisions when it comes time to trading. You have to literally start to accept the fact that you're going to be right only 50, 60, 70% of the time. And that's okay, because with the right equity management, if you're just right 50% of the time, you can take home a ton of money. And so that's what you're going to be learning, how to become that master trader and how to keep your emotions in check.
Siento un curso que tenemos que llevar. ¿Cuántos cursos estás dando? ¿Cuáles?
Ahí está.
A ver, chicos, ¿qué tal? ¿Qué tal? ¿Cómo están? Hola. A ver, los que se encuentran todavía conectados, chicos, me gustaría hacer un pequeño resumen, ¿no? De lo que fue las primeras 3 sesiones. Primeramente, chicos, me gustaría contarles, ¿no? Todo el proceso, cómo pueden operar. Tienen que saber que cuando se opera en Forex, tú sabes que vas a tener un PIP, tú tienes que tener un stop loss donde tú vas a detenerte, o sea, no puedes estar esperando que siempre vas a ganar, porque como todo dentro de este tipo dentro de estos mercados, no puedes tú controlar todo. Por eso es muy importante que te formes, porque al final la academia te va a enseñar todo lo que tú necesitas. Te vamos a enseñar todo lo que realmente requieres para saber cómo vas a entrar y cuándo vas a salir en un mercado, ¿no? Pero siempre tú eres el que tiene la decisión de poder colocar cuánto puedes estar dispuesto a perder y cuánto quieres ganar. Normalmente vas a colocar vas a perder $1 para ganar $3. O sea, siempre vas a colocar un 1 de pérdida y 3 de ganancia. Entonces, más o menos, ese sería un estándar de lo que deberías tener. Ahora, tienes que saber también que nunca vas a tener una temporada invicto, siempre vas a tener momentos en donde vas a ganar o vas a perder. Es muy importante que sepas que tú vas a tener un 50 o un 60% de posibilidades de ganar dentro del Forex. Ahora, ¿qué es en sí? ¿Qué fue lo que entendiste como Forex? O sea, el Forex es simplemente el cambio de una divisa a otra divisa. Y esa fluctuación que hay es el cambio de pronto que cambia $100 americanos por $100 canadienses y en ese momento están a la par y luego cuando vuelves de viaje a Estados Unidos y quieres volver a cambiar los dólares canadienses a dólares americanos, te dicen que ya no son $100, que son 80. Por lo tanto, has tenido 20% de pérdida porque en ese momento hubo un cambio entre las dos monedas. Entonces, es muy importante que entiendan realmente qué es el Forex Exchange, el cambio de monedas de país a país, el cambio de moneda del yuan, el cambio de moneda del euro, la libra esterlina, siempre vas a tener un cambio. Entonces, al final, eso es lo que queremos aportar. Ahora, chicos, esta es solo la primera sesión. Vamos a hacer la segunda, ¿no? Para explicar un poco más. Voy a paralizar por acá y luego continuamos.